Hello, this is Rebecca Benneyworth. This session for Tolley Seminars Online is on the Budget 2015, the capital taxes changes announced in the budget. There are a number of changes to capital gains tax. The first is on non-resident disposals of residential property. We knew quite a bit about this based on the consultation during the summer, but we've got a lot more information both in the Red Book and in a separate standalone guide that HMRC has published, which has got 23 FAQs in it, which really set out the regime in a little bit more detail. We won't be able to see the returns for non-residents until after April, when they will effectively be in force. But what we've got is, as planned, non-resident individuals, trustees, partners and closed companies will be liable to capital gains tax on the disposal of a UK residential property. These properties come on charge on the 6th of April 2015 and rebasing will be available, but that is optional, and disposers will alternatively be able to straight line time apportion their gains between the period up to April 15 and the period after that date. All disposals will have to be reported on the new non-resident capital gains tax return. There'll be a whole process. It will be submitted online and the return must be submitted within 30 days of completion, even though the effective date, of course, for capital gains tax is exchange. Obviously, it wouldn't be sensible to actually measure from exchange. So once the deal has gone through and the transfer is completed, the disposer must make this return and pay the tax within 30 days. It's very, very important that you appreciate that even if the gain is exempt or there are reliefs or there is a loss, if a non-resident individual disposes of a UK residential property after the 6th of April 2015, they must make a non-resident CGT return. For those non-residents who are within the scope to self-assessment, possibly because they have rental income on the property, they will be able to alternatively pay their tax as part of their normal self-assessment bill. They can take the opportunity to pay the tax earlier if they choose to. Now, in a related change, and again a little bit of information was available about this in the autumn statement, we've got a bit more clarity on when PPR claims will be available to non-residents on these residential properties. So from the 6th of April 2015, anyone who wants to make a claim that a property they own is eligible for PPR relief must be resident in the country where the property is situated. If they're not resident in the country where the property is situated, they will have to show that they have spent at least 90 midnights in the property in the relevant tax year for which they are claiming that that property counts as PPR. In relation to UK properties, non-residents won't have to go through this process if their spouse or civil partner is UK resident, and the normal residence rules and the PPR rules will apply in that case. But the rule does apply slightly wider than you might think, because if a UK resident individual wants to claim that a property in another country is actually their PPR, they will once again have to spend at least 90 days in that property in the relevant tax year after the 6th of April 2015. So they may well have claimed relief prior to April 2015, but that won't be available to them any longer unless they spend 90 days in the property concerned. Obviously, for non-residents, this 90 days that they spend in the property could compromise their non-resident status. So obviously that number 90 has been chosen for that specific reason, and people are going to need some really careful advice about what is the best thing to do. Usefully, the FAQs do confirm that if you have now moved abroad but you were living in the UK in a property that you are now to sell, your PPR up to 2015 is undisturbed, and in fact the property only comes on charge in April 2015, assuming you've met the temporary non-residence rules. And therefore you will have until the 5th of October 2016 to sell the property, because the last 18 months rule will cover that period, and I think that's quite useful. Many of you will want to talk to clients who have gone abroad to live to decide what is the best thing to do over the next 18 months with a property they may still own. Still on CGT and turning to entrepreneurs relief. I made mention of this in the business tax section of the budget seminars. The entrepreneurs relief on a related party disposal of goodwill, so by an individual to a company that is related to them, will no longer be available, and that started on the 3rd of December 2014 when the announcement was made. It parallels the disallowance of intellectual property relief in the company, and for those who wish to incorporate, they'll now need to either use incorporation relief or holdover relief to cover any gains on goodwill on incorporation. So you'll have to dig out your old style way of doing things and get that set up as the way to go for incorporation. There has been a late announcement on this one, and that is that if a partnership incorporates and any of the partners actually depart at that time, they will benefit from entrepreneurs relief on the sale of their part of the goodwill to the company, because they will not be effectively involved in the related company. More entrepreneurs relief gains which are deferred into EIS or social investment tax relief. The gains obviously are reinvested and rolled into the qualifying shares, or indeed in the case of SITA, the qualifying loans. In this case, what HMRC has decided is that the entrepreneurs relief will be preserved. So when those gains resurface on the sale of the EIS shares or the SITA investments, then they will still attract entrepreneurs relief, so that will be effectively preserved. So that applies to reinvested gains from the date of the autumn statement, that is the 3rd of December 2014. On associated disposals for entrepreneurs relief, a tightening up of the requirements. An associated disposal must take place around the time and after a material disposal. But a material disposal, particularly in relation to a company, the qualifying requirement is 5% of the shares, but it would be possible to sell 1 or 2 shares and still have a material disposal. So the change is that from budget day, the 18th of March 2015, an individual will have to sell at least 5% of the share capital of the company in order to qualify for relief on an associated disposal. If he's selling a share in a partnership, he will have to sell at least 5% of the partnership assets to qualify. So it's not 5% of the amount that he owns, but 5% in total of the assets of the partnership or the shares in the company. Turning to property taxes and a little overview of things that we had announced in the autumn statement. So we had SDLT reform and the replacement of the slab tax with a stepwise tax, at which each rate is imposed only on the slice of value up to the top of the band. So that was dealt with in the autumn statement. I'm not going to say any more about that, but the rates are in your notes. And a huge hike in ATED, some of the bands have increased by more than 50%. So another one of these taxes where once they've got you signed up for it, it's really possible to turn the screw. We were also expecting ATED to be extended to properties valued at $1 million from April 2015, and that will happen, although there will be a transitional period until October to allow time for returns to be made. And of course, worse to come, because that limit is due to go down to 500,000 on the 1st of April 2016. And finally, on IHT, the Chancellor announced at the dispatch box that HMRC would be looking at the use of deeds of variation as IHT mitigation devices to, in fact, much hilarity on the government benches, because it's fairly well known that the Miliband's used a deed of variation to, let's say, come out with a better answer quite recently. There'll also be some targeted anti-avoidance looking at trusts, but the previous intention to have an overall limit on multiple trusts has not been proceeded with. We've also got, and something that was announced in the 2014 budget, the extension for those killed on active service or who died of their injuries on active service in the armed services, also extended now to emergency services personnel and international aid workers responding to an emergency. So a parallel there with the armed services exemption. Those are the capital tax changes in the budget 2015. I hope you found that useful. Thank you for listening.